Hello everyone, welcome back, and today we're going to start part 2 of how to pay off any loan velocitized, right? This is the velocity banking way. Now what you want to do, okay, is make sure that you know about the cash flow index. Now what is the cash flow index? What is that all about, and why do I need to know it? Man, I'm so glad you guys are good question askers. All right? The cash flow index is what you're going to use to make sure that you're paying off the correct loan. Because many times people say, listen, I'm going to pay off the highest interest rate loan. Or, I might as well do that because that number, well, it's bigger than that number. And I was always taught, yes, you were always taught, absolutely. But what I want to reveal to you today and submit to you for a recommendation on implementing this in your payment history is, instead of looking at the interest rates, which really don't give us a whole lot in terms of how or what loan we should pay off, instead, let's look at our cash flow. How much cash flow are we losing? Seriously. How much cash flow are we losing? And don't we need to plug that up first? Is that supposed to be our main concern? And let's go ahead and look into that. All right? The cash flow index formula reads like this. Your balance, you're going to take your loan balance, okay? And you're going to divide that by your minimum monthly payment. I call it the minimum monster, right? You're going to take your balance, you're going to divide it by the minimum monster, and you're going to come forth with a number. And that number is going to be your CFI, or your cash flow index. Now, with your permission, I would like to give an example of this. All right? Let's say you have $10,000, okay? And you owe $10,000. The balance is $10,000. So let's just go ahead and write it out, shall we? The balance is going to be $10,000, and we'll write 10K for short. And you have been permitted to pay $100 a month for that $10,000, right? So let's just go ahead and we'll mark it $100 a month, right? Now, you guys do the math, all right? What is 10,000, okay? We're going to go ahead and make it easy for you, right? With 3 zeros. Just joking, that's for me, all right? 10,000 divided by 100 is what? Take away these zeros right here. It's 100, right? Okay, so 100 falls where on the cash flow index bar? Where does it fall? It falls in the freedom zone, doesn't it? Okay, so this tells us that we are good to go, all right? It tells us that we don't really need to worry about this $10,000, to be concerned about it. No, not at all. But can I ask a question? What if it wasn't like that? What if instead of paying $100 a month, we were paying $1,000 a month? Okay, let's go ahead and pay $1,000 a month. Now what? Now what are we going to do? Well, let's go ahead and take out that other zero and this right here. Well, now our cash flow index is 10, which puts us where on the cash flow warning scale? Where does it put us? It puts us in the danger zone, doesn't it? Because 10 is between 0 and 50. And so since that puts us in the danger zone, what is that telling us? That's telling us that we have an inefficient loan. Now this is regardless, right? Regardless of how long it takes. And of course there are other factors, right, that could play into this, right? But the bottom line is you're looking at your cash flow and you're saying, well, which loan is draining the most cash flow? And all this takes is just a little bit of math. And if you're having trouble with this, don't worry, we have help for you, right? If it falls between 0 to 50, any loan that you have, and you can do this formula right now as you're watching the video, okay? Some of you have loans out there and you're wondering, well, wait a minute, does my loan fall between 0 and 50? And if the answer is yes, then what we want to do is we want to go ahead and eliminate that loan as quick as we can. Now, if it falls between 50 to 100, whatever your cash flow index number is, then what you'd want to do is you'd either want to restructure that loan, refinance, maybe you can lower an interest rate, or you can negotiate and say, well, you know, I've learned this new method, right? And you can talk to your banker, you can talk to your loan officer. I've learned this new method of calculating how much cash flow is coming from me, right? If I could just get it between 100 and above, that'd be great. Hey, you never know till you ask, okay? Listen, that's what you know to do. So what the goal is to make sure that we stay away from the inefficient loans, right? And many of that, you're just going to have to take as an expense, because many of those inefficient loans are what? They're actually producing cash flow. Many of you have income producing assets. And is that okay? My goodness, that is okay, all right? But we want to let you know how to prioritize those loans, and this is how you prioritize each and every one of your loans. Doesn't matter if it's a credit card, it doesn't matter if it's a bank loan, it doesn't matter, okay? What does matter is if you are utilizing this cash flow index formula to make sure that you save on your cash flow. Because once you pay that inefficient loan off, you got all that cash flow to do what? That's right. Snowball into another loan. And remember, the higher the cash flow, the steeper the debt payoff. Woo! All right, folks, listen, if you got any questions, don't hesitate. Contact me, creditwiz@investorpro.org. Like this video. Why doesn't YouTube have a love button? You know what I mean? Hey, like this video, subscribe, and we will talk to you soon. We still got 28 more days, folks. This is an awesome loan payoff class, and we're going to show you each and every step of the way. All right? God bless, and have a great night.